All right, everybody, I'm Logan Allec. I'm a CPA, and in this video, I want to talk about S corporations. I want to set the record straight in this video because I have seen too many pieces of content online from well-meaning people basically implying that once you make a certain amount of money in your business, you got to set up an S Corp to save on taxes. I've even seen tax professionals make this recommendation as well, almost blindly. Well, folks, the truth is that S Corps are not for everybody. There are some warnings I have for you about S Corps that I will share with you later in this video. My business is personally structured as an S corporation for tax purposes because that's what made sense for me. It might make sense for your business as well, or it might not. So in this video, I want to set the record straight. I'm going to cover how you become an S corporation, how S corporations can save you on taxes with an easy to follow example. Then I will get into the advantages and disadvantages of S Corp so you are fully informed before running your business as an S Corp for income tax purposes. Before we start, I do want to mention a company that I am working with right now called Collective that basically specializes in S corporations. They handle everything for you from incorporation, which is setting up your LLC or corporation, to making the S election itself, to bookkeeping support, to payroll support, filing your personal and business tax returns every year. You can ask them questions throughout the year. So as a CPA, this really impressed me that they can do all of this under one roof nationwide. They're not in every state yet, but they're in most of the bigger states and some of the smaller states as well. If you want to check them out, feel free to use my link in the description below with my promo code Logan, Logan, and you'll get 50% off your first 2 months with Collective. So that's a pretty sweet deal. All right, now let's get into S Corp. So for starters, an S corporation is not a legal entity. It's a tax election. You don't go to your state Secretary of State office and fill out a form with the Secretary of State to form an S corporation. No. What you do is you go to your Secretary of State, you form an LLC or corporation with your state, and then you make an election with the IRS using Form 2553, election by a small business corporation, to elect S corporation status for your LLC or corporation within 2 months and 15 days of forming that LLC or corporation. Optionally, if you have an LLC, you can, prior to making your S Corp election, use Form 8832, that's the entity classification election, to elect to be taxed as a corporation and then file Form 2553. There's obviously more detail than that. For example, most states accept the federal S Corp election, though some states have a separate state S Corp election. They have to file at the state. Something else to know is that there is relief for you if you're filing your S Corp election late. I'll probably make a video on that in the future, but that's the gist of setting up an S corporation for a new business. Now, moving on to the point of this video. Why would anyone elect S corporation status in the first place for their business? Well, let me say this first and foremost. For the most part, setting up a business entity and electing S corporation status does not entitle you to more deductions in general. Okay, it's not like, oh, if you have all these business expenses, you can't deduct them if you don't have an LLC or an LLC tax as an S Corp. That's not the case. You can still deduct all your business expenses on Schedule C, even if you're just a sole proprietor with no separate legal entity set up, if it's just you and your DBA. But an S Corp can save you on the Social Security tax and the Medicare tax, and this is really the major tax benefit of the S corporation. So let me illustrate this with an example. Let's say that you are a sole proprietor for tax purposes. So you do not have an S Corp, you have no legal entity, or maybe you have a single member LLC that you haven't elected S Corp status for. And let's say in your business you net, after expenses and everything, let's say you net $100,000. And let's say this is your only income for the year. Let's say you're single. Let's say you take the standard deduction. Let's say you don't have a deduction for health insurance. You'd end up paying about $10,000 in regular income taxes on this income, assuming no other adjustments that don't have to do with your business, right? So we're assuming the only thing on your tax return is the $100,000 in net business profit, the deduction for half of your self-employment tax, which is self-employment tax deduction is rounded to $7,000 here. I'm rounding a lot of stuff in this video just for simplicity. You also get your standard deduction, and you get your QBI deduction, which I've likewise rounded. This gives you a taxable income of a little over $64,000, which would have a regular income tax liability of about $10,000. And in addition to your regular income tax, you'll also pay self-employment taxes of about $14,000. You calculate that by taking the $100,000 net profit in your business, multiplying it by 92.35%, and then multiplying that by 15.3%. That's 12.4% for Social Security and 2.9% for the Medicare tax. So your total tax liability is about $24,000. That's the scenario if you're a sole proprietor, meaning you have no entity set up, or you have a single member LLC, but you haven't elected it for it to be taxed as an S Corp. Now, what if you do have an S Corp set up? What would your tax situation look like? Well, in this case, let's say that you net the same $100,000 before paying yourself. Now, one thing about S Corps is if you have your own S Corp, you have to pay yourself a reasonable salary. That's what the IRS says. So let's say you do this, and you determine, or you pay someone to determine, based on your industry and what you do for your business, you determine that a reasonable compensation for you is an annual salary of $40,000 per year. Okay, there are services out there you can use that do a reasonable salary study to determine that figure, but let's just say that $40,000 is reasonable here. In this case, you only pay that Social Security tax and that Medicare tax on this $40,000. We call that the payroll tax. So 15.3% times $40,000 is about $6,000. $3,000 of which is paid by you as the employee, $3,000 of which is paid by your S Corp as employer, but obviously only the $3,000 employer piece affects the net S Corp's net income. So your net S Corp income, the income that's going to show up on your Schedule K1 from your S Corporation, is $57,000. Keep that in mind, because now we're going to jump over to your Form 1040, your individual tax return, and take a look at what your individual tax situation would look like in the S Corp scenario. So on your 1040, you would have the W-2 for $40,000, right? This is your W-2 from your own S Corporation. You would have the $57,000 from your S Corporation K1, okay? So you take the $40,000 in wages you paid yourself, plus a $57,000 K1 gives you a $97,000 adjusted gross income. You take this amount, less your $12,550 standard deduction, less your $11,400 QBI deduction, which is basically 20% of the $57,000, gives you taxable income of $73,050. And your regular income tax on $73,050 is about $12,000. So the total tax in the S Corp scenario is a $12,000 regular income tax, plus the $3,000 in payroll taxes paid by your S Corp, plus the $3,000 in Social Security and Medicare withholding taken out of your paycheck as an employee, for a total combined tax liability to the federal government in the S Corp scenario of $18,000. You compare that to the sole proprietor scenario with its $24,000 liability. With the S Corp, you could save $6,000. Okay, $6,000 you can put into your business or invest or what have you. So you do lose a little QBI deduction with the S Corp scenario because you don't take it on the $40,000 in wages, but you more than make up for that with the Social Security tax and Medicare tax savings. So that's the S Corp tax strategy in a nutshell. Keep in mind, however, that you will likely incur additional costs for having an S Corp, right? Payroll costs, cost to filing the S Corp tax return. What if your state has an income tax on S Corp? You know, for federal income tax purposes, there's no income tax on S Corps. But here in California, for example, S Corps pay 1.5% income tax, and the minimum tax is $800. So even if 1.5% of your S Corp income is $500, you still have to pay $800, right? So you have to weigh your S Corp decision holistically, weigh all the costs and all the factors, not just the taxes. Later in this video, I'll do a rundown of the advantages and disadvantages of S Corps. But for now, let me just pinpoint some situations in which you may not want to be an S Corp. Situation number one, in which you might not want to set up an S Corp, is if it's for a side hustle, but you also have a well-paying day job. So as I showed you in my earlier example, the main way an S Corporation can reduce its owner's taxes is by reducing their self-employment tax liability. With an S Corporation, only the shareholder employee's wages are subject to the Social Security and Medicare taxes. The other earnings are not, though they are still subject to regular income tax on the shareholder employee's tax return. The self-employment tax rates are 12.4% for the Social Security portion and 2.9% for the Medicare portion. But taxpayers only pay the Social Security tax on combined wages and self-employment income up to an annually set Social Security wage base, which is $142,800 this year. Wages and self-employment income in excess of the Social Security wage base amount are not subject to the Social Security tax. So if you make at least $142,800 in your W-2 job, your only self-employment tax is the 2.9% Medicare portion. In this scenario, the tax savings generated by electing S Corp status for your business may not outweigh the additional costs, such as payroll processing fees, the cost to pay a CPA to prepare the S Corp tax return for you. Also, your S Corporation will have to withhold both Social Security and Medicare from your wages paid out of the S Corp, regardless of if your day job wages exceed the Social Security wage base. As an employee, right, you can get a refund for the excess Social Security taxes withheld for your paycheck when you do your Form 1040, but you can't get back the S Corp's portion of Social Security withholding on your wages. This is not the case if you file as a sole proprietor, in which case you do not even have to pay the Social Security tax on your net business income in the first place if your day job employment income exceeds the Social Security wage base for the year. Situation number two, in which I wouldn't recommend an S Corporation in general, is if you want to take your business public, right? If you want to take your business public in the near future, an S Corporation may not be the right choice for you, since an S corporation cannot have more than 100 shareholders, nor can they have shareholders other than individuals, certain trusts, and estates. Situation number 3, in which I wouldn't recommend an S Corp, is if it doesn't make sense in your state. Your state may have different rules for S corporations than the IRS does. In fact, your state may prohibit individuals in your line of work from electing S corporation status for their business. For example, real estate brokers here in California cannot run their business as an S corporation. Also, your state may not offer the same tax benefits to S corporations for state income tax purposes that the federal government does for federal income tax purposes. For example, New York City-based S corporations will still be subject to the standard 8.85% corporate income tax rate, right? That's not good. Situation number 4, in which I wouldn't recommend an S Corp, is if the QBI deduction says otherwise. As a sole proprietor, all of your net business income is eligible for the 20% qualified business income. That's the QBI deduction, subject to certain limitations. With an S Corp, however, only your net S corporation income reported on your Schedule K-1 is eligible for the QBI deduction. Wages paid to you from your S Corp are not eligible for this deduction. That means that all else being equal, your QBI deduction will likely be higher as a sole proprietor than as the owner of an S Corp. And the higher regular income tax rate, the more valuable your QBI deduction is, and therefore, the more this reduction in the QBI deduction is a drawback of electing S corporation status for your business in your particular situation. That doesn't necessarily mean that you shouldn't elect S corporation status if you're in a very high tax bracket. It's just something else that should be considered when analyzing whether electing S corporation status for your business makes sense or not. All right, now let's talk about S corporation advantages and disadvantages, starting with the advantages. And you have to weigh, right, advantages and disadvantages against each other to decide if an S Corp is right for you, or you can work with a professional to help you make that decision. In the description below, I have my link to Collective. They're a firm that specializes in S corporations for one-person businesses. Now, like I said earlier, personally, I felt that the advantages of electing S corporation status for my LLC outweigh the disadvantages. But my situation is unique. Your situation is unique. You really have to think through all these things to determine if an S Corp is right for you. But here are the advantages. Advantage number 1, like I said, a reduction in Social Security and Medicare tax liability. I showed you earlier in the video. Electing S corporation status can reduce a business owner's Social Security and Medicare tax liability. Advantage number 2, pass-through treatment. Unlike C corporations, which pay tax on their own taxable income, with the owner also paying taxes on any dividends received from the corporation, S corporations do not pay tax on their income for federal income tax purposes. S corporations rather pass through their net income and other tax attributes, such as tax credits, to their shareholders, and the shareholders report and pay tax on these items on their own tax returns. Note that some states, such as California, like I said, do impose an S corporation level income tax, so for state tax purposes, S corp shareholders may be subject to double taxation at the state level. Advantage number 3, possible reduction of audit risk. S corporations do statistically face lower IRS audit risk than sole proprietors reporting on Schedule C. That said, a popular S corp audit trigger is paying too low a salary to the shareholder employee, so make sure that your salary paid out of your S corp would be considered reasonable by IRS standards. All right, now let's talk about S corporation disadvantages. Disadvantage number 1, you got to determine that reasonable compensation. S corps are required to pay their shareholder employees a reasonable salary. Determining this amount can be a little bit tricky, though there are specialized services out there to help you determine your reasonable salary. Also, putting yourself on payroll means incurring payroll costs to payroll processors like Augusto or an ADP. Disadvantage number 2, additional tax return filing. Your S corporation will need to file its own tax return form 1120-S. Hiring a CPA or other tax professional to do this will cost you at least $1,200, $1,500 or so. Also, your individual tax situation may be more complicated as well now that you have to report that Schedule K-1 you received from your S corp. Disadvantage number 3, S corp is not available to certain professionals in some states. Some states have rules barring certain professionals from running their business as an S corporation for tax purposes. For example, in several states, real estate brokers cannot run their business as an S corporation. Disadvantage number 4, possible double taxation for state tax purposes. Most states do not impose double taxation on S corporations, but some states do. Like I mentioned earlier in the video, California imposes a 1.5% income tax on S corporations with an $800 minimum tax, and New York City-based S corporations are subject to the standard 8.85% corporate income tax rate. Disadvantage number 5, everything must be allocated pro rata. Unlike partnerships, which permit specially allocating tax items to their partners, S corporations must allocate all items of S corporation income, deductions, and credits to their shareholders exactly according to their ownership percentage. Doing otherwise could cause the IRS to determine that the S corporation has more than one class of stock, which would cause the S corporation to be involuntarily terminated. So should you form an S corporation for your business? I can't tell you the answer to that question in a YouTube video. You have to crunch the numbers yourself. You have to weigh the advantages I talked about with the tax savings and all that versus the disadvantages, the additional costs, and additional tax return, payroll costs, and all that. Like I mentioned previously, you can check out Collective. They specialize in S Corps and taxes for S Corp owners. They're basically a one-stop tax and accounting shop for S Corp owners. They handle entity formation, so if you don't have an S Corp yet, so they can set up your LLC, elect S Corp status on it. They handle accounting and bookkeeping and payroll and taxes, your quarterly taxes, right? That gets a lot of people behind. They handle your S Corp's tax return, your individual tax return, a lot of other things. Collective members save an average of $9,000 per year. It is a subscription-based platform. You can use my link in the description below with my promo code Logan, Logan, to check them out, and you'll get 50% off your first 2 months with Collective. If you like this video, there are some similar videos related to taxes over here and over here on the left-hand side of your screen. There's a video I made about LLCs. What is an LLC? Do LLCs save you on taxes? As well as a video on my $1,000 an hour side hustle. If you haven't seen those videos yet, be sure to check them out. I'll see you over there. Bye-bye.